Welcome back to the Innovator, the Imitator, and the Idiot. I'm Kyle Wong with Moxie, Colorado.
I'm Corey Martin with Bank of England Mortgage here in Denver, Colorado, and we are the Quarter Zip Kings. That's right. That's right.
Now that that's out of the way, today we have a really exciting one. It's kind of sarcastic, but not really. It's the real estate market update. We are in, as of filming, early March. It's March 7th.
Yep.
We've had some interesting ups and some interesting downs over the past couple of years, but really over the past couple of months and weeks. So first and foremost, let's talk about what happened in early 2023, numbers-wise.
Yeah. I think so March 7th, coming to the end of the quarter here, I think that what we've seen so far is that interest rates have jumped around a little bit within that 6 to 7% range. And so they haven't gone really above 7%, but they haven't gotten below 6% either. And so we've got a lot of information coming into the Fed, the Federal Reserve. That's who determines these interest rates, right? And they're taking a lot of information and reacting to it. So there's jobs reports, there's inventory reports, there's the CPI, Consumer Price Index, which is basically the cost of goods, which is essentially just like how much it costs to stay alive, right? I think it's like a gallon of milk, carton of eggs.
That's right. Yeah, something like that.
Yeah, just the basics. And so the consumer price index, the jobs reports, these are all things that all information that the Federal Reserve takes to make their decisions on what to do with interest rates. And they've had a lot of information coming their way over the last 3 months or so, and they've reacted to a lot of it. Reacted to a lot of it. And so we've seen, like I said, interest rates from low sixes to high sixes. They've generally stayed in that realm.
Yeah, cool. Yeah, there's been a lot that's been going on. Numbers have reflected that. It's been interesting because I heard from somebody else that they had to call a couple of their clients because in what was it, a 2 or 3 day period, these are not like major spikes like we saw back in 2022, but just enough that people went from qualified to all of a sudden they're not qualified for a house, which is not good. So good for those people.
Yeah, it's tough, right? You think of like 1/8 of a percentage point, right? So 0.12.5%, right? That could, depending on your purchase price or your loan amount, that could greatly change your, how much your housing payment is, right? 0.25% could, or I'm sorry, 1/4%, or 1/8 of that 0.12% could greatly change your actual monthly payment. That could take your monthly payment from, just using round numbers, from, $1,000 a month to $1,050 a month, or $1,100 a month. And depending on what your loan application looks like, that could actually make you ineligible for a certain loan due to your debt to income ratio.
Exactly. So even the small changes are big changes when you talk about them at scale. So early 2023, here's what I find interesting. So early 2023, just from the real estate side of things, man, it was slow out there, and a lot of people were kind of a little barren, if you will.
Mm-hmm.
And you saw the effects thereof. Examples being a lot of real estate teams or real estate companies started to be like, hey, we really like your portfolio, you should come join our team. So you'd see a lot of real estate brokerage and team changes, which I always think is kind of comedic. Yeah. But also, it was just slow. And so on the buyer side, it was really advantageous in a lot of ways. So I talked about this in a previous episode, but it really did shift towards a buyer's market.
Absolutely.
If you look at numbers, technically it was still like leaning on the seller side, but expectation wise, sellers were like, oh shoot, it didn't sell within 5 days, so what the heck is going on? And so the expectations had shifted from sellers to buyers, where I had a buyer who we came in $11,000 under asking. We got $1,000 concessions at closing before we have even ever submitted the offer. And then when we got the inspection back, we got a full HVAC service and replacement. We got windows replaced, as well as, radon mitigation system. And on top of all that, a home warranty for the client paid for by the seller.
Right.
In 2022, especially early 22, that never would have happened. Like, it's a joke, right?
The buyer would have had to do all of those things for the seller on their next property.
Yeah.
You know?
Yeah, on top of my firstborn child. Like, it's insane. And so seeing that shift was quite interesting. But what's even more interesting was kind of what's happening now.
Yeah.
So go and talk about the numbers, and then I'll just talk about that experience-wise.
Yeah. So what we've seen now is that interest rates have, if we're looking back over 2 years, right, they've doubled. All right. Going back to 2020, they've doubled, right? And if we go back to 2021 around this time, they're about 3%. And then we go to 2022 and now they're starting to increase, right? And so when the Federal Reserve came out this most recent week, they kind of said, my bad, y'all, like, my bad. There's a little bit of maybe we jumped the gun and maybe we hiked interest rates a little bit higher than we anticipated on doing. Just a reminder, interest rate hikes are used to combat inflation. And so, the Federal Reserve trying to combat inflation, trying to make sure that, the cost of living doesn't go up so high, they increase interest rates. And what we've seen, like I said, is that they may have overcorrected themselves. And so that coupled with some more data coming back to us, some more information that we can expect to come back to us in the next couple months, we anticipate that interest rates are actually going to come down a little bit. I don't know that I would like to see them, I think, down to 5s, maybe. I think that would be great. But, I'm a loan officer in Denver, Colorado. I don't have the Federal Reserve. I don't have, Mr. Powell's cell phone number. We don't text or DM or anything like that. That said, though, with the information that we know, inflation seems to be coming down. We do seem to have a little bit better job market. I think we can say that interest rates will probably come down a little bit.
Yeah.
Right now they're at the high 6s. We can at least say, lower 6s, hopefully into the 5s in Q2.
Yeah. Well, with that in mind, that's super helpful because I know a lot of people are still scared of the market.
Yeah.
And rightfully so. For a lot of people, they've just simply been priced out, or just hearing all the articles, hearing all the hearsay. It can be pretty intimidating, especially for a younger or a newer home buyer. Right. So that makes sense. But with that in mind, just numbers and data aside, it's so funny how the pendulum seems to swing from one side to the other.
Right.
Because I had mentioned earlier, it's very advantageous for your buyers, right? Which is awesome. Like it's great because a lot of those people who didn't have a very strong position in 20 or 21 are kind of now in a better position to buy. But then it kind of came back the other way, right? So in 2023, turn of the year, right, I said it was slow and it was kind of better for your buyers. And now I've seen over the past couple weekends multiple offers, offers due by Sunday at 5, things like that. So all of those things just mean that we've had a lot of interest on properties. And keep in mind, the overarching theme here is that inventory is still low. We say this like every episode because it's been true, and it probably will be true for many years to come, like seriously decades based off their current estimates.
Yes.
We just have a lot of people and we just don't have a lot of homes.
Right.
That's the simple fact of the matter.
Yes.
And so with that, I think expectations, number one, have been switched a little bit. So sellers are kind of more like, wait, actually, I still am in the power position here. Like, I have the house and you guys want it, and there are multiple of you, right? But the other side of that, though, is that the buyers are like, wait, there's no reason to be scared. I just talked to my financial professional, and they said we can still get in with a 2-1 buy down, or, seller concessions, or whatever it is.
Right.
And so now you have buyers coming back into the market. So I kind of joke that like buyers are flooding the market again, because they kind of are. So not just because of the interest rates and all the numbers, but also because it is pretty seasonal, right? Springtime, summertime's usually the hot
Right.
times to move or to sell. And so you have a lot of people just coming back. for that reason alone, but a lot more people that can afford those houses, especially after the slight correction that we saw in the home prices, making it more feasible for more people.
Yeah.
And so, with that being said, seeing these houses, I mean, gosh, I submitted an offer on one in Evergreen, and it was the craziest thing because it was still $500,000. So it's not like necessarily a cheap house. But yeah, they said not to bring back PTSD from like 21 or anything, but we need, appraisal gap language. We need limited inspections on this one. Like, we need the offer by 5, and make sure to submit all that in one clean offer. And it's so funny going from like 1 month here with my buyer to another month here with my buyer.
Oh yeah,
completely different.
The market has, what the expectations are, like you said, have changed, and how you're able to get your offer accepted in March, and certainly will in June is not going to look anything like what it took to get your offer accepted in say December 2022, right? So right. I think things have changed a lot. And one thing that you mentioned that I thought was really interesting was the market correction. And what we've seen over the last, call it 9 months or so, in a market correction as interest rates have started to increase. And I think what we were talking about is that, homes aren't appreciating at the same clip or the same rate that they were in 2020 or 2021 or even early 2022. But that's okay, because in 2020, 2021, and 2022, the market was basically high.
Yeah. Oh yeah, yeah. So let's talk about that really quick, because we all hear the sayings like the market's high, the market's good, the market's bad. What do those mean? Those are all like subjective and not based on anything. So first of all, when I say correct, I know you know this, but for everybody out there, when I say correct, I don't mean like a drop or like a crash or anything. I simply mean a correct, meaning we are closer to the trajectory of what has been historically accurate, right? And so going from, what did we see, 17% appreciation year over year, which is insane. It's insanity. Sometimes higher, sometimes lower.
Let's specifically call that out.
Yeah.
A home that was bought in 2020 is now worth 27, or in 2021 was worth 17% more than it was in 2020, right?
And then 17% more the next year.
It's
insane.
So, that just doesn't happen, right? You don't invest into the stock market and expect to see a 17% gain return on investment, right?
Yeah.
There's not many places where you can put your money and say, where you can deposit $100 and you're going to get $117 back in a year. That just doesn't happen. Usually it's like, I might get $103 back in a year.
Something, right?
That's
which is
normal.
good. Which is fine.
Yeah, which is fine. That's great. That's great. So that's just what we were talking about as far as the appreciation differences there.
Yeah. So, I mean, you guys that tried to buy, or you guys that perhaps have sold during that period, that it was nuts. It was crazy. And the reason was cost of borrowing was low. Obviously, interest rates were around, some people got as low as 2.5%, which is nuts.
Right.
But like 3%, 3.5% maybe. But it was crazy. And so seeing that correction, right, from 17% back to like 2 or 3%, that's a big difference, right? Because you're coming from, like, I always joke, like euphoric highs. Now it's time to sober up. We're coming back to reality.
Yeah.
Actually, Bill McAfee's the one who said that, so I guess I have to give credit where credit's due.
I guess.
Anyways, from 17% to a more realistic 3%, that is a correction back onto the trend of where we should have been all along. But going from that high to that low feels like a big difference, because it is, right? So if we went from something more normal from 3 to 6, you'd be like, well, that's not much of a correction. It is a correction, it's just a bigger difference. So it's always the change that we feel. And the fact that rates got hiked up so fast, because he knows this, rates get hiked up real fast and then they come back down real slow.
Right.
So, seeing that big change real fast, halting the market, holding things where they were just about like we froze in time, it was very jarring for a lot of people. And so from 2022 2022, right, early 2022 to now the end of 2023 where things are slowed, and then coming back a little bit where expectations have changed, numbers dropped a little bit from the peak at 7 or just around 7 down to, what are we at, 6.5 now, in between 6 and 7, and now going back into the summertime, which is already pretty hot, going into what, maybe 5.5, 5% maybe.
By June. We're not saying that interest rates are going to be at 5.5% come the end of March, right? April 1st, 5.5. We're saying June, July. But that talk about a market correction.
Oh gosh,
I don't know.
It's like this. So that, I mean, that's why we do this though, because it seems like every 3 days there's a completely different shift, and so we're trying to stay on top of things as best we can, and just relay that information to you as our consumers and our clients. And so, with that, it's a lot. It's a lot at times.
So we've talked about where things have gone, or how we got here.
Mm-hmm.
We've given historical context on the last 2 years, and we've given context on the last 9 months, as that's a different market as well. We were talking before this, and we were kind of trying to figure out what does Q2 of 2023 look like? What does April, May, and June 2023 look like? What could we compare it to? And I think that we were saying that it would look a lot like it did last year.
Yeah.
Where we've had, or I'm sorry, I guess the summer of last year, where we've had interest rates were, not low, not historically low, right? Not in the 2s and 3s,
Sure.
But certainly not in the 7%, right?
Yeah.
So there's still people that could qualify, still people that could qualify to purchase a home, but it was a hot market, is what we were thinking.
Absolutely, it was. Yeah. So that's interesting because, again, we don't have a crystal ball. We don't want to quote this and 6 months go down the line and we're, oh my gosh. We have the exact same information and access to the information that you do, but just based off what we've seen, what we've heard, what we've been around, that's kind of what we think. Yeah, so market-wise, it's going to be hot. I really do think. I think spring has already shown us that it's hot. People have a high pent-up demand. I want to buy a house. I wanted to buy a house for 2 years and I can't. Right. So now I'm ready. I'm going to pull the trigger. Yep. And so you have lots of people flooding the market. You have lots of people that are capable, that have that desire, and expectations have changed. They're ready to go right now because we've been preaching about hey, your pockets now. This is your time. Get a house. Yep. And so they've finally heard. They've caught up, and now we're seeing the effects. Spring, summer, I think even into fall and winter, it's still going to be a hot market. Whereas the numbers are going to be in the, 1 year ago mark.
Yeah, I think so too. I think if you were planning on, I want to speak to certain people out there. If you were planning on waiting for an economic collapse like 2008, 2009, it ain't happening. I'm sorry, it's just not happening for several reasons. 2008 and 2009, we were putting people into homes that weren't, that couldn't afford those homes. The economy was not as strong. We weren't having as many people enter the first-time home buyer age range and earning space as we do now, right?
Which is now 34, right?
Yes,
30. I thought I said 32 in another video, but maybe it was 33 or 34. It's around that range, 32 to 34.
What we're saying, though, is that more people are going into their 30s in 2023 than they were in 2008.
Yeah.
Right? There's more of that demographic there. And so with that, there's more demand. Yeah. So if, I foreclose on my house, it's not like there's a lot of people out there that can't afford to buy my house either. No, if I foreclose on my house, this guy, and that guy over there, they're waiting to buy. And so that's why we're not going to see these drops in home prices. The bottom is not going to fall out. The demand is there. We don't have enough homes, enough inventory to meet the demand that we're seeing right now. So I say all of that to say the bubble is now. Or I'm sorry, the pocket, window is now. There's no bubble that's going to burst. That's not happening. We have more people ready to purchase homes than ever before. And so with that, demand is going to be higher. We're not going to see home prices bottom out. We've just seen them appreciate at a 2 and 3% clip versus a 17% clip.
Plateau.
So, those folks that have been waiting for that, I just wanted to say, get off your horse. Now's the time. And if you have questions about anything, we're happy to answer it. Certainly recommend that you ask questions to learn more about the market. But waiting to see home prices drop 20, 30%, it ain't happening.
And we don't say that just as like a sort of scare tactic or like, here's a false sense of urgency. Like, we want to give it to you straight. That's the whole point. We're here to educate you. We do this for free, technically. This is for you.
You didn't get paid?
You guys are getting paid?
Oh, sorry, man.
All right, we'll talk about that.
We'll talk off camera.
Talking to my manager.
But no, this isn't a scare tactic. This is just to make sure that you have the information that you need. I do think that there a lot of times there are some scare tactics used in this space, or not necessarily scare tactics, but people that are waiting for that are playing on negativity, right?
Sure,
and banking on negativity. And we just want to give you real facts, real information that we don't necessarily gain from giving you or withholding ourselves.
Because truthfully, like, if something bad were to happen, or if like the bottom were falling out and like the sky is falling, like, I would hope that we're the first to tell you. Mm-hmm. We want you to be educated and really make a better decision. So we're telling you what we think is going to happen because that's what we actually believe. There's no like manipulation or deceit here. But just to clarify, like when he says home prices aren't dropping, because what we're saying is the appreciation has just gone down. So think about it like this. It's like if you go from a sprint to a brisk walk. Yes. You're still moving forward, just not quite as fast. It's a very similar thing for, going from 17% appreciation, right? Not home value, appreciation year over year to 3%. So you're still appreciating a little bit here and there, but it's just keeping up consistent with inflation and job, all that stuff.
Yep.
And so we want to make sure that that's very clear to all of you guys. It's not like, hey, wait 6 more months and then you can buy some awesome REOs or like foreclosures or whatever. And the other thing is, I also don't think, we were just talking about this before we started filming, I don't think personally, actually a lot of experts in the field think this as well, that we haven't seen quite the full extent of the correction, because a lot of people are like, okay, well, you just said you've seen multiple offers and like demand is high, so why wouldn't home prices keep going up? I think a lot of the creative financing that has either come in or come back, so seller financing, wraparounds, assumables, 2-1 buy downs. Again, all of those are fine. Yeah. They're not bad. It's just a lot of those seem to have artificially held up the market, if you will. Right. So when we went from 3% to 5% and then to 7%, that person that was qualified for that house at 3% cannot afford it, or probably couldn't afford it at 5%, definitely couldn't afford it at 7% if they're financing, right? And so what I mean by that is a lot of times people would engage in these creative financing deals that would get them into a home that they technically, and this sounds bad, but technically couldn't have gotten into at that time or been able to afford. Yeah. And what I mean by that is, under the current terms, right? They can afford the terms that they got into under, like, a lot of times, right? This is very common here. VA, seller assumables.
Yeah, seller assumables. Yep.
Right. So VA, they got into a house at 2.5%, 2.75%, 3%, and now market's back up to 6.5%, and people are like, hey, I want what you have because you're moving, and I don't want a loan for 6.5%. Yeah. Cool. I mean, there's a couple extra things we need to do, but let's do that, right? They could not have bought that house either in cash or with a traditional conventional loan. It's just not possible. So I think that's part of the reason why the market's kind of, been held up a little bit through these financing methods, if that makes sense. So
it's what it's saying is that, correct me if I'm wrong, you're saying that creative sellers. You're right. So what you're saying though is that creative seller financing has allowed this market to continue to allow people to still get into homes.
Yeah.
If we didn't have creative financing options, then sellers would have been forced to drop home prices even more than they already did to make their home more affordable for people as interest rates increased. But because we have these creative financing options available, we were able to keep home prices at the same rate or at the same level, and then offer, lower interest rates or ways to get into a lower interest rate, and thus keep the same amount of home price, right?
That's exactly what I'm saying.
Man, I am never wrong. Never wrong. But you know what? I think we've given a lot of information here today. This was supposed to be a market update, so that way you guys can understand how we got to where we are and what you can expect over the next few months. If you guys think that something different is going to happen, please do
let us know.
Yeah, comment on the video, comment and let us know, or reach out. You can always schedule a meeting with one of us via the link below.
Yep.
No matter what, if you have questions about the market or have questions about real estate here in Colorado, please just reach out. In any market, though, there is always
the Innovator,
an Imitator,
and the Idiot.
I'm Corey Martin with Bank of England Mortgage. Please don't hesitate to reach out to us if you have any questions about personal finance.
Yep. Boom. The market has been updated. And I'm Kyle Wong with Moxie, Colorado. Reach out. Comment. We'd love to know where you're from, if you're from out of state or if you're local. We're always very curious, actually. We were just tracking numbers recently. So we'd love to hear from you. Schedule a call with us. Hear our voices face to face. Quarter Zip Kings, baby. We'll catch you next time.
That's right.